please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, clearly there's a lot of distribution in the mid-caps while the Nifty is somehow still holding the 200-day moving average. It's breached it, I mean, not convincingly, but trading around the 200-day moving average. But mid-caps looking weak. 1:3 is what we have on advanced decline. Housing finance is one area where we are focusing on now. There are some pressure points emerging on stocks like PNB Housing. We have Sanjay Gupta, MD of PNB Housing, now joining us. Mr. Gupta, good morning. Last 1 week or so, we were all talking about the developments in the loan against property book. How's that shaping? Because a lot of analysts have expressed concerns over some bit of excesses building up in that side of the business.
Well, as far as the growth on loan against property goes, it's being very stable, and also the credit quality on that portfolio. And as I keep saying, that's not a regulated product, so different lenders have got different nuances of doing that product. We are one of the conservative players, and we are very happy to report that the quality of our portfolio is standing strong.
Okay. Good morning, Mr. Gupta. I think Fitch, some of the rating agencies have placed your parent PNB on rating watch with negative implications. CRISIL, of course, has clearly said that the outstanding ratings on PNB Housing and PNB Gilts remain unaffected. Will it be at all, will you have any problem at all raising money? Will it be a little more expensive than it was, say, last month or in January?
Not really, Lata. What we are more concerned is at a macro level is on the liquidity position. And the way the GSEC curves are moving up, that will be universally be adversely impacting the entire sector. Because, most of the housing finance companies have 50 to 55% of their total borrowings from the capital markets. So that's more of a concern rather than our own, I would say, treasury. Because we were fortunate that all the rating agencies reconfirmed our rating. And I think that was a point of inflection to decouple the parent from this associated company.
Okay. Mr. Gupta, good morning. I wanted to ask you specifically what is the exposure that you have, to houses built by a few of these stressed companies. So names like JP Infrastructure, say an Earth Group, Supertech, etc. And are you seeing any additional stress come in from some of these names?
Well, we have no corporate exposures to the brands that you mentioned. But yes, the retail exposures are there. And to our utter surprise, the customers are holding on and the payments are not adversely impacted as of now. And I expect that the year will end that way. Because we are a very, very cautious player when it comes to, extending even individual loans to the sort of projects which are not getting developed or which are not seeing construction to be, with the program or with the pace. So we are lucky because we have been rather conscious in exposing ourselves both on the corporate side and on the retail side.
You don't have corporate exposure to the names that I mentioned, but in general, on your corporate exposure, are you seeing any additional stress or have things improved a bit?
Not at all. In fact, the story is converse because we have been conservative in choosing the developers, the projects, and the market positioning of the project. So we don't do either the luxury end or the bottom of the pyramid. We generally expose or extend loans where it is a mass market project, and those are still moving pretty all right.
Actually that, Mr. Gupta, I'm looking at your past 6 quarters of growth. You've been growing your AUM at over 50%. And that also is a cause of worry because overall, right. The market is not growing so much. So your aggression is also a cause of worry. Any thoughts on that? And a related question, what is the total percentage of your book that you, of your sources of money that you raised in the last 1 or 2 years? What percentage of the money did you raise in last 2 years?
Okay, so first is that we are not an aggressive player. We are a player which puts capacity in place and then put it to economic use. And that is why our growth rates have been so phenomenal. And the portfolio is holding on good. And the best indicator is that our 2-year lag NPAs, and that is coincidental NPAs divided by the portfolio which was acquired 2 years hence, is half of the market or the industry averages. And I'm sure this year also, when CRISIL does that study at an industry level, we will be holding our position. Okay. So it's not to worry, because it's I would say, a very well regulated growth, or a very controlled growth, and a very well planned growth, and an engineered growth that we are talking about. Okay. It's not about I would say, out of the box aggression.
Okay. And how much money did you raise in the last?
Type of I didn't get your.
How much money did you raise in the last 12 months and 24 months?
We generally do market operation. Well, it's about 30,000 crores in the last 24 months, and it will be about 18,000 crores in the last 12 months.
Okay. So that's about 25%. I mean, the point is, at that time, money was very cheap, and that can get repriced a little expensively when you roll it over. Okay. So you expect margins to be impacted for FY19?
Well, the average are. I think our book, which is going to be repriced on the borrowing side, is about 27 to 30%. And not the entire book is going to be repriced, in the coming financial year. So yes, about 27–30% of the book is going to be repriced. Yeah.
Okay. The show, well, the Sandhar Tech IPO opens for subscription today. The company makes two-wheeler locking systems, rear-view mirrors for commercial vehicle markets amongst 21 product categories, also including wheel assemblies, sheet metals, aluminum components, basically a lot of auto ancillaries. Jayant Davar, the co-chairman and managing director, joins us now to talk about that. Mr. Jayant, thank you so much for joining us on the show. You have a lot of marquee clients in your list. I wanted to understand what the growth trajectory could be for this business, because the auto ancillary space has picked up a lot. So many new players entering into the market as well. Yeah. What kind of growth do you see over the next 2 to 3 years?
Well, it's difficult for me to give you any numbers at this point of time, but from an auto perspective, I can give you what the sectoral numbers are likely to be. At this point of time, we have all cylinders roaring in some sense. A lot of this has to do with government policy, so the agricultural impact of whatever policy is done, you have the tractors doing well, you have the infrastructure space, and we have as a company, we have a new sectoral expansion which has been in the space of construction equipment. Okay. And that's firing on all guns. With the rural demand going up, you have a huge amount of growth in the two-wheeler segment, for example, the motorcycles especially. The cars are doing well. So after a long time, you see the auto sector doing well in almost every aspect of whether it's two-wheelers or four-wheelers or three-wheelers or commercial vehicles or tractors and what you have. Yeah,
actually, is that the reason? I mean, I'm just looking at your numbers from FY15. Your EBITDA is 144 in 15, then 146, and then 152. And now looks like you will do 200 crore in the current year, going by the 6-month number. Likewise, net profit, 38, 33, 39. And then suddenly in the first half itself, you have done 35 crores this year. Is there a capacity expansion as well, or is it just demand?
We've invested over 600 crores in the last 5 years into areas like the construction equipment business. A lot of those units where our typical asset turns are about 3 times. So 650 crores till last year was giving us only 200 crores in revenue because it was capital expansion in progress. Now that revenue has started to come in. So that's one. The other thing is on the bottom line numbers. We had these new units, 13 out of our 29 units were in some kind of losses because they were being put up as we speak. Okay. As now they come into revenue mode, obviously the bottom line is, so we had almost 35 crores of losses coming from these 13 units. That loss is reduced to 17. So obviously there's a big pickup there. We've grown by 25%.
So you're on the cusp of the capex cycle.
That's right. So we expect that hockey stick to now, as the revenue starts generating from those particular investments.
Okay. Mr. Dow, good morning. So that's interesting, and you've done, of course, remarkably well with your company. So the question here is then, why do you need to do an IPO at this time? I know it's for debt repayment, but it's not that large. And if your company is growing, I guess...
Two real aspects, actually. One is, at some stage in life, in a maturity of a company, it's important to discover a price. A large reasoning behind it is also the fact that there are loads of opportunities that come on the table. And unless you have a price discovery, it's impossible to get any kind of structured finance in any sense. So you only have to depend on debt. And that kind of gets heavy as you go forward. So it was time for us to do that. The other thing is we have a private equity investor in our company, and it was important to provide an exit to that. So both things combining, we thought it was an adequate time for us to look at it.
Lest we run out of time, just wanted to quickly ask you a follow-up to what my colleague was referring to. You know, the growth, the capex that you've put in, it's going to result in rewards now. Yeah. But do we see higher margins as well once the new plants ramp up? Because you've already reached double-digit margins.
Absolutely. Now. So when you're investing, there is a certain amount of capital expenditure that goes on to the OPEX and to the revenue expenditure side. So there has been a drop in the last few years. And now that revenue started operating out of there, a lot of, so we've seen a 120 basis points jump in the EBITDA margins already. Okay. Typically, one would expect that with losses now going down even further from those ingraining companies, one would see that number should ideally go up in the future.
So 12-13% margins is what
I can't give you numbers here today. Right. Subsequently, perhaps.
Yes, we will touch base with you after the listing. Pleasure speaking with you. Thank you very much, Mr. Howard, for dropping by. Okay, so that's the IPO on the table, but let's revert to the big theme that we have been speaking about, the Rising India Summit. On the sidelines of this summit, I caught up with Nobel laureate and economist Paul Krugman on a whole host of issues, ranging from President Trump, tariffs, China, India in the global context. Listen to a very interesting excerpt from that chat.
I think the thing to understand for global politics and so on is that his vision of the world, such as it was, is the way the world was 50 years ago, you know, when he was a young man, and he hasn't caught up with this modern globalized world that we live in.
Okay. No, I'll tell you, on a more serious note, the point is, you know, he did come with promises to a certain category in America, people who had lost jobs. That's right. To, you know, the shifting of manufacturing to China. But a lot of people thought that he won't implement those tariffs. But as time passes, he has remained true to all those election promises, and what looked like impossible is actually coming true.
Well, a little bit of it has. Now, we still don't know. I think he probably doesn't know whether these are, he's doing a few dramatic things to make it look like he's doing what he said he would, or whether this really is the start. I mean, you know, America, even America, big country, but we're still very embedded in this global economy. There's no such thing as a U.S. product. Everything is a global product, and business doesn't want to see that disrupted. And that's a counterweight. On the other hand, yes, he made a lot of promises. Basically, that I'm going to bring back the manufacturing jobs that we had 40 years ago, which is not going to happen, but he may be tempted to try some extreme measures to do that, and the steel tariff was certainly a start in that direction.
We missed the bus when the Asian tigers and China got into the global manufacturing cycle. What should India do now? Can we get into the cycle now?
I think India can. I mean, now, in some ways, the success of Indian service exports worked against manufacturers. It has kept the rupee stronger than it would otherwise have been. And it means that India has not been as cheap a place to produce as you might have expected. But on the other hand, India has this enormous wave of people coming along, so it needs to employ them. And India still has reasonably low wages. Productivity is low, but not as low as some other places. I think infrastructure used to be a big issue, transport infrastructure. It's gotten better.
Yes.
Still not first class, but it's better. So why not? I mean, you have neighboring economies that are major manufacturing centers. They're even poorer than India, but there's this. I would say, let's put it this way: a successful Indian future would include a lot more manufacturing being part of this global manufacturing system.
End of 15, early 16, we almost were scared about the way China was dumping, and the yuan looked like it could fall, and the reserves flowing out. Do you think 2018 holds any kind of danger from China?
Well, there's always. I mean, the Chinese situation has looked unsustainable for 7 or 8 years. Now, of course, the problem is if maybe the fact that it's gone on so long means that we're wrong about it being unsustainable. Yeah. That could be true, but it still looks as if they have too much investment, too little consumer demand. They keep it afloat with this constant wash of credit. There was a period of capital flight. They cracked down on the capital flight, but it's probably still a lot of pent-up desire of money to get out of China. You know, when one of these days, reality probably will catch up with them, and it's going to be nasty.
That was Paul Krugman. By the way, the market is not looking good, especially on the mid-cap side. And the problem here is that the last week mid-caps outperformed with the thought that perhaps the bottom is in place. And now that theory is at risk, normally you see mid-cap unwinding, and that's what's happening right now. 1:3.5 almost on advanced decline ratios. So